There are more and continued calls for a fiscal stimulus to jumpstart the economy. The Q1 GDP data, which is expected at the end of the month, is expected to show growth remain below 6%. But there's much confusion, firstly, about where the slowdown is stemming from and then what we can do about it. Joining us to talk about some of that is Rajeev Malik, founder and director at Macro Shanti. He's joining us from Singapore. Rajeev, good afternoon. Thanks so much for taking the time to speak to us here at Bloomberg Quint. Much confusion in the narratives, the solutions, etc. So let me first ask you about what you make of what you have seen from the incoming data, not just the last round of GDP numbers, but since then the high frequency data and the commentary from the RBI and the MPC. What's your understanding of the state of the economy right now?
It's really the most surprising thing to me is how surprised people seem to be about the unfolding slowdown. The seeds of this and the signs of it were apparent even around the beginning of the year. And if you think about the budget that was just a short time ago, there was really no hint in that the state of the economy would warrant some kind of a stimulus package, because the budget certainly didn't talk about it. So I find it quite perplexing in a way as to how quickly people have shifted a narrative from talking about how non-agriculture growth was strong and core inflation is high and therefore the central bank should not, MPC should not cut rates, to now completely going the other way. The fact of the matter is India had started to slow down even as global growth was holding up well, and now that it's going the other way, we will see a more pronounced impact of that. To a large extent, India's growth was predominantly a one-trick pony, relying on private consumption, which had been held up in large part by debt financing. And post the NBFC crisis late last year, a lot of that unraveling has taken place. So, after 3-4 years of strong private consumption growth, there's a natural tendency for momentum to slow down. We were beginning to see some signs of that, and then it got whacked by the whole NBFC fiasco, and that further slowed things down. And that is getting overlapped with now a global growth dynamics, which is going to play out even much worse. So, the future is always bright in India, and next year's growth will always be far better than this year's growth. But my sense, and I think I mentioned here several months back as well, there is no reason to think that growth is going to turn around anytime soon. We could clearly be down in the dumps for longer, simply because my main assessment for India remains it's like a truck with a messed up gearbox. You can change the tires, you can paint it, you can do many wonderful things, but till you get the gearbox going, and that to a large extent is the financial system, you're not really going to see any meaningful revival, let alone as far as investment cycle itself is concerned. So to a large extent, the slowdown has domestic drivers. It is going to get complemented by external parameters as well now. It is both cyclical and structural in nature. RBI governor may not think so about the structural angle, but all you have to ask yourself or ask any analyst is whether her expectation about trend growth in India have come down. And that clearly will tell you a structural dimension is at play.
Sure. Rajeev, I have two questions. One is there a case for a stimulus? And, should there be a stimulus at this juncture? And if that be the case, what are the options?
So, any kind of a slowdown analytically has three policy options to be dealt with. One is, of course, your fiscal side, fiscal stimulus package. The other is on monetary easing side. And the third, somewhat related to the second one, is exchange rate depreciation. India has not really aggressively followed the third option, so let's keep that aside for a moment. We've seen the rupee depreciate. A lot of it has to do with global dynamics. And I don't think there's going to be any concerted effort to weaken the rupee substantially, because that then unfolds its own Pandora's box, opens up its own Pandora's box in terms of investors, especially on the debt side, becoming a lot more scared and staying away. That leaves us fiscal and monetary. We've already seen monetary easing come through. My view remains that the MPC has been slow off the mark and has moved gingerly. It could clearly have been more aggressive. And even now it can be more aggressive given the headroom comfort it has on the inflation front. But in India, the focus is always on the fiscal side, because bad news can also mean big business. And at the same time, the issue is a plain vanilla stimulus by itself is not really going to do much. It should be complemented with some long overdue reforms, be it on the factor markets, be it on the financial sector side. These are tangible issues that will only make any kind of a stimulus more effective. My sense remains, and as is typically the case, especially in India, but also in other markets, investors and financial markets are always betting on a bigger, more aggressive stimulus than what is going to come about. My own sense of this government is that it's not really losing its head about the speed or the nature of slowdown. And as typically happens, the child that cries the loudest will get most milk. In India's case, the sector that's making most noise about the slowdown and its implications, especially politically sensitive job creation, will probably land up getting some goodies. But it is going to be targeted predominantly on sector-specific private consumption side, maybe a bit on infrastructure because that's always an evergreen area. But that's pretty much about it. I would not be too hopeful of a very aggressive, a big package that comes and does everything. I don't think that's on the table.
Rajeev, just going back to, some people say it's a theoretical debate about the nature of the slowdown, although I don't think it is. On the structural side, is it largely the financial sector that worries you? There have been some analysts who have pointed to the fact that the savings rate has been sort of slightly declining and consumption as a percentage of GDP has been going up, like you said, sort of probably debt fueled. Is that also an issue? Because if it is, then the manner in which to tackle that is a whole different ballgame.
It is, and again, bear in mind, India is still very much an evolving story, right? I mean, our household indebtedness is really not as high or as worrisome as some of the peers might necessarily experience. But it is fair to say that when you have a combination of savings rates going down and private consumption actually holding up quite well, and clearly debt has been the intermediary there, that actually can't continue forever. And clearly something has to give. Now, is that a structural or a cyclical slowdown? Well, if you think that debt financing can continue forever and ever, obviously there is nothing wrong with it, but that is not really the case. It's also interesting that once again, India is showing that it is difficult to maintain its high growth phase. We've been through these cycles, different cross currents, different pressure points. But sustaining growth at a high level in India's case has always been challenging. And once again, that is coming about to be the case. My sense is, I think both the etiology of the slowdown and what needs to be done, both are a bit in a limbo. And part of it is, I think, for the last several months, we have selectively tried to ignore some of the signs that were indicating that, look, a slowdown is imminent. And at the same time, the MPC, I mean, if you look at MPC's growth forecast over the last several sessions, it is absolutely amazing. It's been cutting its growth forecast by a minuscule 0.1 percentage point every 2 months. That's not even a rounding error for any analyst. And, so at a time when they clearly had the option of stepping up and trying to come up with a more aggressive interest rate response, fully well knowing that the transmission has been weak, that to me actually argues for a more aggressive option, not a more timid option, as has been the case.
If the government were to sort of respond with sector-specific measures, as you are indicating, it really doesn't have the fiscal headroom, does it, to go and spend? Where's that money going to come from, you think?
So that's where you get into the next step, right? I mean, as I often say, policy making is about solving a problem without creating another one. And as you rightly pointed out, there's not much fiscal headroom, which is precisely why it is not going to be a big package, so to speak. There's a natural slowdown unfolding. Don't also forget that this government has relied much more on microeconomic delivery rather than macroeconomic growth. And I think the election result itself showed that quite effectively. So I think a slowdown, unless it is very pronounced and has a catastrophic impact as far as job creation is concerned, you're not going to see a big, aggressive, be-all and end-all kind of a package. Auto sector will clearly be one beneficiary that will come through. Whether that happens directly as to what is given to the sector or in terms of some cuts in taxes that make cars cheaper to borrow, which essentially means you're borrowing growth from the future. So at some point that is going to run its course as well. Like I said, I don't expect a big package, partly because the fiscal concerns are still very much there. Even if you go by the official numbers, if you actually take a more realistic picture, the actual fiscal picture in India is far more expansionary what the official numbers would be suggesting. So to me, between the fiscal side and the monetary side, I would actually say there is more scope still on the monetary side, as long as the MPC does not move in a very gingerly manner as it has been doing. But ultimately, as happens in India all the time, it's going to be a little bit of everything. So a little bit of fiscal, a little bit of monetary side will come together to try and carry the burden.
So you do think there's still more space, Rajeev, on the monetary side? So we're down at 540 on the repo. What would be, how would you judge the room? Let me ask you that way.
Well, which is where I think MPC in its recent meetings has only created a lot more confusion or uncertainty in a way, right? I mean, earlier on at least, we had some kind of a hand-holding guide in terms of real interest rate that has been completely thrown out of the window because nobody talks about it anymore. But at the back of their mind, there would be still some kind of a benchmark, and I would think a repo rate going down to 5% is not outlandish at all. Now the question is, should they move aggressively and do it, as a one-step bullet, 40 basis points, or they do it in 15 and then 25? I mean, those are really silly combinations that we are dealing with now. No other country does that, and I don't want to bring up China and Taiwan again, which is what everyone who's trying to apologize for this 35 basis points tries to do. They have not followed India's pattern, and they certainly are not the benchmark or the yardstick for monetary frameworks. So I think there's another 40 basis points to come through on the repo rate, at least. Whether it's done in one time or two steps is anybody's guess.
Rajeev, one last question, this one on the liquidity and sort of the credit market environment. So, now liquidity is on days 2 lakh crore in surplus, but it's done precious little. Even if you look at the AAA bonds on the corporate side, you have hardly seen any reduction in the spreads. In fact, the spreads have widened because, the market is not willing to let these bonds trade beyond a certain point of a yield. So the market is just, it's not frozen, but it's not willing to transmit this. So forget about the lax transmission on the banking side. This time, even the financial markets are not really transmitting easier policy.
Well, that's right. And there's a good reason for it, because partly the worry is purely on the fiscal front. And, the question really is what happens to the kind of premiums one would have to deal with. So we've seen an aggressive move in risk-free rates coming down. But clearly now with more talk about fiscal side and how worried or desperate the government is going to be in its response, because it seems to have been somewhat caught off guard. Otherwise we would have seen some constructive action in the budget itself. So even if it is at the margin, they will have to do something. And as you rightly point out, that is what is contributing once again to the transmission not being effective. So the solution is very much with the government to try and deal with that. I should point out that once again, while the stimulus package can be there, it is not as if the government does not have options to try and limit the slippage. Privatization is always there, and everyone will come back and say, look, it's politically sensitive, but look, something has to be adjusted. Equally, there's a whole host of assets that can be monetized, land banks, etc. Maybe it requires a bit more thought process to go through those kinds of things. But a lot of that monetization can actually take place, and now's the time to do it. The typical pushback on privatization or selling stakes is, are you going to get the best price? And again, a lot of times it is not about getting the best price, but whatever is the right price at that point in time. And there's a big difference between the two.
Okay, Rajeev, I'm going to end with the last question, which is slightly intangible, but to me it remains an important one. And you're viewing this from the outside. Do you see enough sort of thought leadership either within the government or within the central bank to be able to pick all these parts apart and say that this is the right mix of solutions? It seems both at the government level and at the MPC level, we're not getting a coherent either sort of solution or an understanding of the problem.
Well, I would agree with you. I think there is a missing link, or rather there are several missing links. Investors don't need to be taught about vocabulary or tough words, as Governor Das tried to do a couple of days back. They're looking for clean, simple assessment and what potential options can come about. And we are well past that situation where everyone had a rah-rah approach about the fastest growing economy. I think there are very relevant, tangible, important issues that need to be dealt with, and just a plain vanilla fiscal package is not going to do it. It'll have to be complemented with both monetary side and with underlying structural reforms. But because there is not much talk about it, there's hardly any talk, and just trying to reassure investors day in and day out with the same placebos begins to lose its significance. So I think there has to be some thought leadership that has to step up, whether it is from MOF or from RBI, to try and give investors a sense that policymakers know exactly what's happening.